Welcome to this official sector panel on the transition to risk-free rates. I'm joined by 5 panelists from the official sector: Edwin Schooling-Latter from the UK Financial Conduct Authority, Nate Werfel from the Federal Reserve Bank of New York, Cornelia Holthausen from the European Central Bank, Roman Baumann from the Swiss National Bank, and Bertrand de Mazière from the European Investment Bank. My name is Paul Richards from ICMA, and I will be moderating the panel today. We plan to cover 3 main issues on the panel. First, progress on the transition from LIBOR and the other IBORs to risk-free rates so far, despite the market impact of the coronavirus pandemic. Second, the remaining challenges to complete implementation of the transition in time, including legacy issues. And third, the importance of international coordination, how this works, and what it involves. I would just like to spend 2 minutes giving you background in a nutshell. In July 2017, Andrew Bailey, then Chief Executive of the FCA, which regulates LIBOR, said that the FCA would no longer intend to persuade or compel banks to submit contributions for LIBOR after the end of 2021. To avoid the problems with LIBOR, the authorities want financial markets to transition away from LIBOR and the other IBORs to near risk-free rates. In all the main jurisdictions, the chosen risk-free rates are overnight rates, for example, SONIA in the UK, SOFR in the US, ESTR in the Euro area, and saran in Switzerland. A common objective has been to make risk-free rates as robust as possible, with robustness measured primarily by the volume of underlying observable transactions. The authorities have warned the international capital markets that LIBOR may not continue beyond the end of 2021, and that they need to be ready by the end of 2021 for the cessation of LIBOR. The transition to risk-free rates is a global challenge. It will only succeed if the authorities and market participants work together. And to help organize the transition, the authorities have set up a series of risk-free rate working groups in the different jurisdictions, which involve the market and the authorities working together. The transition is being coordinated globally through the Financial Stability Board Official Sector Steering Group. ICMA participates in the risk-free rate working groups in the UK, the Euro area, and Switzerland, and I'm chairing the bond market subgroup in the UK, working closely with the FCA and the Bank of England. So with that background, we're going to start by discussing progress in the transition to risk-free rates in international capital markets so far, despite the recent impact of the coronavirus pandemic. Edwin, perhaps I could start with you, and perhaps you would speak about progress to date in the UK, and also about whether the coronavirus pandemic has had any impact on preparations. Over to you, Edwin.
Thank you, Paul. Well, a huge amount has been achieved since the ICMA last convened a panel of this type to speak with the ICMA community. And I'd like to begin by thanking the many people listening to this call who will have been a part of securing the tremendous progress that has been made. If you look across the different products and the different LIBOR currencies, you can clearly see some differentiation in the degree of progress. But to take bond issuers as a start point and an area of particular interest to this ICMA audience, they're really top of the class. So in sterling, essentially all new floating rate notes now reference SONIA rather than LIBOR, as indeed they should. And actually, in US dollars as well, for example, there's been a decisive tip in the scales towards SOFR-linked issuance this year, especially at the longer maturity end, notwithstanding COVID-19. On the derivative side, SONIA dominated overall sterling swaps volumes in the first quarter of this year, accounting for about 2/3 of notional traded, and that reflected high volumes of short-dated swaps in particular, and for maturities of 2 years and under, SONIA in fact accounts for almost 3/4 of the total notional traded. Now at the short end, a lot of swaps activity is associated with hedging and speculation around Bank of England policy rate moves, and that was a particularly intense period in the first quarter. Liquidity at the long end is actually more important probably to the success of the transition. And if I look back to 2019, you could sometimes hear concerns that hadn't yet developed. So the really positive news underlying those headline figures I just drew from is the growth of SONIA liquidity at the longer end. So for example, the volume of SONIA swaps between 2 and 10 years duration increased by 90% between the final quarter of 2019 and the first quarter of 2020. And in fact, in each of the 5 to 10 year, 10 to 20 year, 20 to 30 year buckets, SONIA's share of cleared swap volumes rose above 20% of the total market for the first time. So I hope you get the very clear picture from that COVID-19 has not derailed the LIBOR transition. Of course, some parts of the program have been impacted and timelines have been widened in some places to accommodate that. But as you can see in those facts and figures I just gave, the transition is very much continuing, and there are many areas where that has been able to progress, notwithstanding the virus with which we're all grappling.
Edwin, thank you very much. Nate, a good progress has also been made, I think, by the Alternative Reference Rate Committee, the ARC, in the US, working closely with you at the Federal Reserve on the transition to SOFR.
That's right, Paul. We've seen actually, as Edwin was saying, quite a bit of progress in recent months, despite the fact that we've all been dealing with the COVID pandemic. And in my role, I can speak to the progress from 2 vantage points, the Federal Reserve and also more broadly from the ARC, the Alternative Reference Rate Committee. The New York Fed, as you may know, is a reference rate producer. We produce the Secured Overnight Financing Rate, or SOFR, and that's the ARC's preferred alternative to U.S. dollar LIBOR, along with a number of other reference rates. And, of course, we co-convene the ARC along with the Federal Reserve Board. And from both perspectives, we've seen momentum building around the LIBOR transition. In New York, as a reference rate producer, in March we began publishing averages of the SOFR and a SOFR index. And these SOFR averages are backward-looking rates with tenors of 30, 90, and 180 calendar days. And the SOFR index facilitates the calculation of average SOFR rates over custom periods. We think this is a significant step for the transition because SOFR and other overnight repo rates are inherently more variable than term rates on a day-to-day basis. But the vast majority of financial products aren't expected to use those overnight rates of a single day's reading. Instead, we think many of them will use these averages. And this accurately reflects the movements in interest rates over a given period of time, and that smooths out any idiosyncratic day-to-day fluctuations in market rates. So we're pleased to see that the SOFR averages and index are now produced and beginning to be used, and we, of course, encourage market participants to consider them as they think about the LIBOR transition. On the ARC side of things, the ARC released some key objectives for 2020 in April, and then last month it released its recommended best practices for the LIBOR transition. Particularly in light of the current market uncertainty, the ARC's recommended best practices are intended to clarify the timelines and the interim milestones that the ARC believes are appropriate for transitioning away from U.S. dollar LIBOR, and to do so in a way that really minimizes market disruption and supports a smooth transition. The best practices include near-term steps that market participants should aim to take across floating rate notes, business loans, consumer loans, securitizations, and derivatives. It's really a comprehensive set of dates by which market participants can ensure that they're prepared for the LIBOR transition, that their vendors are prepared, that their customers are prepared, and ultimately that they're moving products away from LIBOR onto robust reference rates. The ARC is also supporting has objectives to support the publication of a forward-looking SOFR rate and spread adjustments going forward. So we think really that 2020 is really a tipping point as we move from sort of planning to implementing the transition.
That's very helpful, Nate. Thank you very much. Cornelia, the focus of the European Central Bank has, I think, so far been on the transition from Ionia to ESTA. Perhaps you'd like to comment on how that's going.
Yes, thank you very much, Paul. I gladly do so. So the transition from Ionia to the Euro short-term rate is following a very clear scenario. The Ionia will be discontinued on 3rd of January 2022 by its administrator, that's the European Money Market Institute. And this timeline has not changed in relation to the COVID-19 crisis. So until that date, several steps should take place. First of all, the European CCPs, they announced plans to switch their discounting curve from Ionia to the Euro short-term rate in the week of 27th July, broadly speaking. So this was actually delayed by 5 weeks because of COVID-19 and the need for banks to prepare for this switch. And this discounting switch should encourage many market participants to align their bilateral credit support annexes amendments with the CCP discounting change. And we expect that this would support the demand for the Euro short-term rate derivative products. So far, the take-up of the Euro short-term rate OIS market has been really modest. There was an initially very encouraging start, but the percentage of OIS products that are labeled in Euro short-term rate that fell substantially to only 0.1% of the OIS volumes in May. And we suspect that this is due to market participants' preference for the most liquid market in the recent market situation of COVID-19. And which remains, so that this most liquid market remains linked to Ionia. But we would expect the situation to change in the next month, and we expect that then a Euro short-term rate-based liquid derivatives market should develop. In any case, market participants are encouraged to prepare for the switch from Ionia to the Euro short-term rate as soon as possible along the following lines. In particular, they are encouraged to limit the stock of legacy contracts indexed in Ionia, and all the more if these mature after the discontinuation date in January 22. And this means adapting to the Euro short-term rate products as soon as possible. And they are also encouraged to replace Ionia as a primary rate as soon as possible in those contracts maturing after 2022. Alternatively, they should embed robust fallback clauses on these contracts. And the Working Group on Risk-Free Rates recommended a fallback rate for Ionia and published precise recommendations to assist them in this process. So we often hear and also believe that this is the case, that the transition from Ionia to the Euro short-term rate is a relatively technical one, and it was facilitated by the recalibration of the Ionia methodology by its administrator, because since October last year, Ionia is equal to the Euro short-term rate plus a fixed spread of 8.5 basis points. And this fixed relation between the two rates provides clarity and transparency for counterparties to switch. And because then both rates share the same economic basis, yeah. Let me stop here.
Cornelia, that's very helpful. Thank you. Roman, you've already made good progress, I think, in Switzerland on the transition to saran, and you might also want to talk about the use of saran in retail mortgages. Over to you.
Absolutely. Thanks, Paul. That's precisely the point I wanted to mention. Has probably been since the last time we had this or held this panel. A key milestone that has been achieved is the fact that a number of banks have now launched saran-based mortgage products. So floating rate mortgages are important in our market and always have been. They have traditionally been based on 3-month LIBOR. These new products that have been launched, they are all based on a compounded saran. This is important, as you might recall, the Swiss Working Group has recommended at an early stage in the process that compounding should be used wherever possible. This is due to the fact that we don't think a robust forward-looking term rate will be achievable in Switzerland due to the fact that our derivatives markets are simply much smaller than they are in the US, the UK, or the Eurozone. So we are working on a compounding basis wherever possible. And take-up in these saran-based products has been very good so far. And I think this shows that the compounding approach works, and it also works for a retail customer base. There has been something that was questioned by some participants. It might be too complex, especially for a retail client. But I think these last couple of months have shown that if you explain it properly to the public, it also works in that environment. Now, it is a bit more complicated. There are several ways of implementing a compounding approach. Our national working group has recommended 3 of them for potential use in retail products, and different banks are using different approaches. And I think a key element was the early inclusion of infrastructure providers. Obviously, banks can only offer saran-based loan products if their core banking systems are able to handle them. And the outreach that we had, similar to what's been done in other markets, especially in the UK, I think this outreach to infrastructure providers at an early stage was very important in order to get the ball rolling.
Thank you, Roman, very much. Bertrand, the European Investment Bank has, I think, acted as a catalyst in the international capital markets in using risk-free rates in new bond issues. And 2 years ago, you'll recall that in the sterling market, the EIB issued the first FRN referencing SONIA, and the market has followed many of the conventions that you used in that transaction. And the EIB has also, I think, played a pioneering role in the SOFR and ESTR markets. Perhaps you'd like to comment.
Thank you very much, Paul. I'm afraid you're too nice to EIB and to me, but I take the compliment as hopefully a reflection of what markets think. Let's say that since I'm the only one here, not to be a rule maker or a standard setter, that the situation for us at EIB is relatively clear. We believe that as long as the ultimate deadline for the discontinuation of LIBORs, and I have in mind especially the major ones, the sterling and dollar LIBORs, as long as the deadline for the discontinuation of these LIBORs remains the same, and it seems to remain the same, and it seems to be really planned for, let's say, the end of 2021, there is no reason for us at the European Investment Bank to change our plans, and I would say that there is all reason for EIB, but also for all the other market participants, all the banks, to focus on organizing, planning, and implementing the required developments in order to be ready, but also in order to mitigate and minimize the risks that are involved in this transition. Indeed, you mentioned that we pioneered in the bond market. I will speak in euro equivalent, if you allow me, but in euro equivalent terms, we've issued by now around 5.3 billion in SONIA, 4 billion in SOFR, and 2 billion in ESTR, in all different interest rate convention structures. And we indeed see this as our contribution to support the liquidity of the cash bond market based on risk-free rates. On loans, to give you an example of, to tell you what we do, we are exchanging with other market participants and with clients. The aim is to prepare for the development of a risk-free rate loan pilot that we expect to have ready by the end of the year. It's difficult work because there's still a lot of uncertainty around the various interest rate conventions, fallback provisions, etc. But we think we have any way to prepare something. An important element is the communication side, both internally and since 2 years ago we have had an internal task force under the remit of the Asset Liability Committee of the institution that has among its duties to actually develop internal awareness and train people and educate our lenders, our risk managers. But we also exchange a lot with clients. And by the way, we've observed an increased awareness in the markets during these exchanges with clients. So there is definitely a general move that's taking place. In general, we closely follow what the rule setters do, what the regulators and the authorities do. We follow closely the market recommendations, and we try to reflect them, to import them in our planning accordingly. And one word on these recent market developments. I must say that I would like to express a particular appreciation for the manufacture and publication of risk-free rate compounding indexes. For us at the EIB, and I think we are not the only ones to say that, we see in this initiative really a driving force to better standardization, to the avoidance of useless competition of slightly different formats. It's a good way to go to simplification of products. It's actually very, very useful, I think, for the opening to retail, and it maximizes the potential for international consistency. So again, this compounding indexes were a great initiative.
Thank you, Bertrand. That was very, very helpful. I'd like now to move on to our second theme, which is the remaining challenges. Although we've made good progress so far, as the panelists have said, there are a number of challenges that remain to ensure that we complete the transition to risk-free rates in time, including on legacy issues. Edwin, I'd like to start, if I may, with you. What are the remaining challenges as you see them for the market to be ready for the permanent cessation of LIBOR? I think the market would also be interested to hear from you about the announcement by the UK Treasury and the FCA a few days ago on tough legacy. Over to you.
Thank you again, Paul. Let me start by highlighting two things I think is really important market participants are busy on in the half year ahead of us. And then I'll turn to your tough legacy question and implications for everyone of the Treasury and FCA announcements on Tuesday this week. So in terms of two key tasks for the second half of this year, the first one I'd like to flag is transition in loan markets. That's clearly the area where least progress has been made to date. And therefore the furthest distance needs to be covered in the period ahead. And certainly speaking for the sterling market, there are some really important deadlines still in the second half of this year. So from the end of September this year, all sterling lenders will be expected to provide borrowers with non-LIBOR options. So only where the borrower specifically wants to remain on a LIBOR referencing contract should that happen. And even where the borrower does want that, there need to be pre-programmed mechanisms to move away from LIBOR before the end of 2021. So not just a fallback that's triggered if LIBOR disappears, but actively to plan the move away from that rate before the end of next year. And indeed, from the end of the first quarter in 2021 now, that's one of the deadlines we relaxed because of the impact of COVID-19, we will be expecting all new LIBOR referencing sterling lending to cease. Now, as Bertrand said, there's some very important work being done on conventions, which can support that transition in loan markets. I think the indexes are also a very important resource that people can draw on. I'm very pleased that Bertrand highlighted that. In our own working group in Sterling, actually across the working groups as well, and indeed with the main vendors in the loan market, there's some very intense work that's been going on to make sure the relevant products and conventions are available in the second half of this year. The second key task for 2020 H2 that I'd like to flag is the adoption of fallbacks across derivative contracts that are subject to ISDA documentation. So ISDA is expected to publish a protocol early in the second half of this year, which will provide those market participants that have ISDA derivative contracts a mechanism to avoid the chaos that would otherwise arise for those contract holders if they are not prepared for LIBOR discontinuation. So I think, as is well known and debated, the current fallbacks in those contracts, which envisage polling dealers for rates, are not expected to be viable if LIBOR disappears. So adopting this amended documentation through the protocol mechanism is a really, really important piece of action that market participants need to ensure they have in their programs for the second half of this year. And I should also flag that for supervised institutions in the European Union and the UK, there are, of course, regulatory requirements to have fallback plans in place in respect of various contracts. And the Is2 Protocol is a mechanism of meeting those requirements. Finally, on tough legacy, it's well recognised in the UK and I think in some other jurisdictions too, that there are certain LIBOR referencing contracts that it's really not possible or practicable for market participants to convert. And that's because of the difficulty with engaging with a multilateral set of stakeholders, for example, in some cases, or in retail contracts, potentially the difficulty of getting engagement from the holder of the contract on the retail side to engage with a transition exercise. So with that in mind, the Sterling Working Group's Tough Legacy Task Force made some requests to the authorities in the UK to look at ways in which the authorities could help. And one of those ways that it flagged was greater capability to change LIBOR at source so that a LIBOR number could continue to be published for those with tough legacy contracts. And that was the subject of the announcement on Tuesday this week, where our Treasury, our Finance Ministry, announced that it would take forward legislation which would give the FCA stronger tools to enable that to happen. Now, there are some very, very important points in relation to that news. I think these have been well understood based on the coverage that I've seen so far. But the first, perhaps almost beyond obvious point, is that this does not mean that transition effort can now be relaxed. So these tools only apply to tough legacy contracts. They do not allow new business to be conducted using a LIBOR number that would be published under this changed methodology. So all new business needs to be ready to work without LIBOR from the end of 2021, as we have said previously on many occasions. The second point that needs to be clearly understood is whilst having these tools available is clearly a good thing and gives us an important option to help tough legacy contract holders, It is not certain that we would be able to use it in all circumstances or for all LIBOR currencies for a number of reasons, but perhaps most obviously it could only be used if the relevant inputs were available to the administrator of LIBOR. And then the third key point is that obviously anyone who did choose that they had to rely on a regulatory action of the type that this power would enable will not have economic control over their contract. And I think it's already apparent that a methodology change which can clearly only deliver a single methodology will not give everyone their first preference in terms of what that number might look like. For example, it's clear that many important markets, including most of those which will engage ICMA members, so derivatives and bonds, indeed the larger end of the cash lending market too, there is a very strong and very sensible preference to use the overnight rate compounded in arrears, whereas obviously the LIBOR methodology is a forward-looking one. So for all those reasons, I will emphasize one more time that where you can transition away from LIBOR rather than rely on regulatory action in a tough legacy safety net, you should do so.
Edwin, that was very clear and helpful. Thank you. Nate, what are the remaining challenges as you see them in the US?
Thanks, Paul. I think given LIBOR's wide-reaching role across the financial system, of course, transitioning is going to be an immense challenge and come with new challenges as the transition preparations progress. And let me pick up on the tough legacy contracts as one area, just picking up on Edwin's comments. These tough legacy contracts that don't have appropriate fallback language, either they fall back to a version of LIBOR or they may not have any fallback at all. These are really, I think, challenges in the LIBOR transition that have been really at the forefront of our thinking also in the U.S. case. And although these contracts could be amended, the amendment process really could be challenging or impossible for certain products. And so, like the UK, we've been giving great consideration to this challenge. And for this reason, in March, the ARC proposed New York state legislation to address this issue, given that a substantial number of financial contracts that reference U.S. dollar LIBOR that might be tough to amend are governed by New York law. And the ARC has proposed New York legislation to address this issue in a way that is narrowly targeted to those contracts that really would face substantial difficulty in the transition. So the proposed legislation would prohibit a party from refusing performance contractual obligations or declaring a breach of contract as a result of LIBOR's discontinuance. And it would establish, and instead would use the legislation's recommended benchmark replacement. And it would establish that the recommended benchmark replacement is commercially reasonable substitute for and commercially substantial equivalent to LIBOR, and provide a safe harbor from litigation for the use of the recommended benchmark replacement. So it's fairly targeted. Again, it would be for those contracts that either don't have a fallback at all or fall back to some version of LIBOR. And I would also reiterate the caution that Edwin made, which is that it's much better to have amended your contracts to go through this transition smoothly than to rely on fallbacks in the first place. And so if that's possible at all, we would, of course, encourage market participants to do that. We've sort of been driving this car of LIBOR for some period of time, and we need to get into a new car. And, one way to stop is to crash and rely on your seatbelts, but a preferable way is really to slow down. Take the appropriate steps to transition and move into these new reference rates, robust reference rates going forward. I do want to say more generally that the growing awareness of the transition also means that we uncover issues that different market participants and sectors have in the transition. And so, of course, the Federal Reserve and other regulators are regularly holding discussions with a wide range of stakeholders to understand their challenges in the transition. As part of this engagement, there's been some banks that have expressed a desire to explore ways to include a credit-sensitive spread that could be added to SOFR for certain loan products. And so we've been holding a series of workshops to better understand the lending needs of these banks and their borrowers, and whether a credit-sensitive supplement to SOFR would be possible to address them. We held our first workshop earlier this month. We think conversations like these are particularly important to support a smooth transition, because our main priority from a public sector perspective is moving the financial system off of LIBOR and onto robust reference rates by the end of 2021 or sooner. And we want to make sure that financial market participants, businesses, and consumers are prepared for that transition when it occurs, and so need to take action now to prepare. And in the U.S. dollar LIBOR case, the ARC has been meeting very frequently to try and identify and address these challenges that pop up along the way. In fact, the ARC has met 8 times so far this year, which is quite remarkable. We've almost reached the number of meetings we had on all of last year. So it's, the work is underway, and there's momentum building around the smooth transition, and we can address these challenges once we identify them.
Thank you, Nate. Cornelia, what are the remaining challenges in the euro area as you see them? For example, I think you've been building in fallbacks from your IBOR to ESTA, and there are other challenges that you have in store as well, I think.
Yes, thank you, Paul. So in the euro area, we are in a very different situation because there's no plan for a Euribor discontinuation at the moment from the competent authorities. And this is an important distinction between Euribor and some of the other IBORs. At the ECB, we are convinced that nevertheless, working on Euribor fallbacks should be a priority for all users. And on top of it, in some cases, it's also a legal obligation for European entities, as foreseen in the European benchmark regulation. So I'd like to stress that users of Euribor should not forget that Euribor remains a responsibility, really, of the private sector, and its long-term sustainability will depend on its administrator, and in particular whether panel banks will be willing to continue to support it, and also the future liquidity of its underlying market. And in our view, users should really be prepared for all scenarios, and including the possible discontinuation of the benchmark. Competent authorities under the benchmark regulation can provide a temporary backstop in the form of mandatory contributions to the benchmark or mandatory administration of the benchmark, but this backstop is limited in nature and time, and it's important to stress that users of Euribor are aware of the current limits to the powers of the competent authorities for the rate. And in our view, all parties that are exposed to Euribor should be informed about the risks attached to this benchmark, and I'm not sure that's really the case right now. And therefore, we would like to stress that a clear communication with clients about the current risks and the setup of fallbacks is a task and duty which lies within each Euribor user. So consequently, the risks related to Euribor should be effectively minimized by introducing fallbacks in all contracts that make use of the benchmark. And given the extensive usage of Euribor in consumer contracts, in particular mortgages, and the associated risks, these fallbacks should be feasible, workable, simple to explain to customers, and also, as far as possible, consistent across products and currencies. And we believe at the ECB that the Euro short-term rate is a robust and reliable rate, and benchmark users should really consider making a wider use of the Euro short-term rate and term structures based on it in both cash and derivative markets, even beyond the current use of Ionia. So in the working group on risk-free rates, the members are working on fallbacks for Euribor contracts, both for new and legacy contracts. And just to give you an outline of the work now to be done, several public consultations are planned for the second half of the year on the various aspects of the fallbacks, and these should assist market participants in choosing the most appropriate ones and amending their Euribor legacy business. So 2 public consultations are planned. The first will mainly survey market participants on the recommended fallback rates for Euribor. and in particular, will survey on the most appropriate Euro short-term rate-based methodologies for Euribor products. I should say that the methodology can vary depending on the products, usages, and counterparties. And market participants are currently discussing various type of fallback methodologies based on the Euro short-term rates, in particular forward or backward-looking rates. So forward-looking rates meaning based on Euro short-term rate derivatives markets, or backward-looking rates, which would be compounding of ester. And the current debates in the working group evolve along these two broad categories. The ECB's preference regarding Euribor fallbacks, it's clear. We are convinced that Euribor fallbacks should be robust and reliable, and we would strongly recommend considering methodologies that are also compounding the Euro short-term rate. We believe that this would be the most pragmatic solution in a world where benchmarks usages can and probably will change, as also shown in the LIBOR jurisdictions, for instance, and also in particular the developments in Switzerland, as just mentioned by Roman, where mortgages are now sometimes also referencing saran and no longer LIBOR. We also believe that the euro market should not diverge too much from other major jurisdictions, which have clearly moved in the direction of these backward-looking rates. The second public consultation that is to be prepared by the working group on risk-free rates relates to the set of trigger events whereby fallback clauses could be activated in Euribor contracts. So this set of events is still being discussed in the working group, but there seems to be already some consensus around the need to recommend the same set of trigger events for all Euribor products, so favoring consistency across the board. And then one last issue that's coming up is that we expect the working group on Euro risk-free rates to publish a Euribor legal action plan by the end of the year, which should outline the high-level steps and processes necessary to amend Euribor contracts to embed the fallbacks. And I'd just like to stress that it's essential that market participants start planning about how to embed these fallbacks clauses in their contracts if they haven't done so already.
Cornelia, that's very interesting and useful. Thank you very much. Roman, how do you see the remaining challenges in Switzerland?
Our major remaining challenge is a very simple one, maybe also a very obvious one. You have to get liquidity into the saran-based derivatives markets, and this is probably particularly difficult in a small market like Switzerland. We have no liquid government bond curve to speak of, therefore we need a liquid swap curve as a backbone for our capital market, more so probably than other markets in relative terms. The saran swap market saran swap curve will take on that role at some point, but it needs to be based on trading activity. We have seen some pickup in trading in saran-based swaps, but liquidity is still considerably larger in LIBOR-based swaps, especially in longer tenures. Edwin mentioned in his opening remarks the very positive developments in the UK in that regard. We have a longer way to go on that front. So the use of saran in loan products like mortgages, which I mentioned earlier, will create demand for hedging, and therefore it should be a help in strengthening liquidity in saran-based derivatives products. But I think really this remains the key challenge going forward.
Roman, thank you. And Bertrand, how do you see the remaining challenges from your perspective in the markets in the European Investment Bank?
I'll be brief on bonds because as it was said at the beginning, they are top of the class. So there, it's just to continue what's been done. It's been a lot of work, by the way, but at least it's working. So I see challenges elsewhere, I would say. First of all, I hear loud and clear the message on the need to work on the legacy contracts and to not waste time into amending them, and again, we are working on that. But it is a fact that on the fallback clauses, there's no standard language in the markets. So it forces market participants, it forces EIB, for example, to to draft their own fallback language for loans, with the risk of actually reaching results that may be at odds or very different from what others would do. So more coordination and more standardization would be welcome. And generally speaking, that applies to loans in general and to the lending side. So as I told you, we are preparing for the development of pilot risk-free rate loan products by the end of this year. But we do that without knowing the details of what could be the gold standard, so to speak, the gold standard template for loans. So it forces us to prepare for different scenarios that we are building with, let's say, consultations with our main commercial banks and clients. But it is certainly probably more time-consuming and more difficult than it would have been with a quicker definition of standards. On derivatives, I would say that potentially the rules of the game are rather clear and will be certainly even clearer with the impending publication of Is2 Protocol in July, and also with the switch to the new discounting rates by central counterparties in this summer in Europe or this autumn in the United States. So I would say standards are clear or clearer, but I'm echoing what was just said about the lack of liquidity. An increase in liquidity is really required, and to tell you the truth, although the preparation of the risk-free rates is under the mandate of the Asset Liability Committee of the bank, we have not yet been able to establish or to use the risk-free rates for the management of asset liability. Although we're working on that as well, but definitely liquidity is a key factor that is still missing, and that's particularly true when you take a cross-currency outlook on the markets. And finally, and that's a point that was well flagged, I think, already by the Sterling Risk-Free Rate Working Group and by the American equivalent, the ARRC. I don't know if you pronounce it ARRC or ARC, I'm sorry. But a point that was well flagged there is that a key ingredient in the transition is the upgrade of the relevant IT systems and applications. And we are realizing that not all vendors are equally prepared, and sometimes actually some of them even use the lack of final decision by policymakers for some conventions as an excuse to their own shortcomings or to their own delays. This is why we put together a dedicated program at DDIB with specific milestones for the upgrade of our IT systems and applications. There, again, having to use different scenarios and market conventions and migrations.
Thank you very much, Bertrand. I think that leads us on to the third subject that we're going to discuss, which is international coordination. There is clearly not a one-size-fits-all approach to the transition in different national jurisdictions, but the direction of travel towards risk-free rates is much the same. There is an important role played by the FSB Official Sector Steering Group. Nate, perhaps I could start with you. How does that work, and what does it cover?
So as you mentioned, LIBOR is a global problem, and therefore it benefits from having some international coordination to facilitate the transition, and that's really the role of the Official Sector Steering Group, or the OSSG. The New York Fed President John Williams is the co-chair of the group, along with Andrew Bailey, the Governor of the Bank of England. And the OSSG was established in 2013 by the Financial Stability Board, really as a forum for senior officials from central banks and regulatory authorities worldwide to develop proposals for key interest rate benchmarks. The OSSG established reform recommendations that provide agreed-upon approaches that are applicable to all the jurisdictions, and that really provides a framework across the jurisdictions to encourage consistency, and it limits the risks of regulatory arbitrage that could emerge with a less coordinated and a more fragmented approach. But as you said, Paul, of course, the group recognizes that you cannot have a one-size-fits-all approach to reform, and that really would not work well. Therefore, it's really encouraging the promotion of best practices that are going to benefit all in the global financial markets in the transition. Coming out of the OSSG are national working groups in jurisdictions worldwide, so the ARC and the U.S. dollar LIBOR case. And these were born out of the OSSG to coordinate where possible and address unique needs of specific financial markets and jurisdictions. And maybe I would just give one example of the way that I think the OSSG and international coordination can be particularly helpful, and that was through the endorsement of a set of principles for financial benchmarks and for robust reference rates going forward, in this case the IOSCO principles. And these really reflect best practices for the administration and production of interest rate benchmarks. So that's something that the OSSG can recommend and then has the spillover effects down to the national working group level. So in the case of the U.S., our Financial Stability Oversight Council endorsed robust reference rates, and the ARC picked up the principles from IOSCO and additional factors to consider in selecting the secured overnight financing rate, or SOFR, as its recommended replacement for LIBOR. And I think that's quite beneficial because at the end of the day, for us to be able to have a more stable financial system, we want to have a set of robust reference rates that are in use around the globe.
Nate, thank you. That was very useful. Bertrand, what are the areas where international coordination is most important for you at the EIB?
Thank you. Yeah, I would say that in general, it's for us extremely, for us as an issuer that issues everywhere, and as an investor and lender that lends and invests almost everywhere as well. It's very important to have the maximum level of coordination, harmonization worldwide, global harmonization. And I would say that there is certainly one point on which harmonization would be quite important. That would be precisely for the management and for any legislative or regulatory intervention for the management of the legacy contracts, whatever the option in the end, to make sure that those who let's say set this legislation do it with a due regard for ensuring that it's not totally askance as to different from what is done elsewhere. I welcome and again I'm very happy with the compounded indexes, but there too I think that the potential for being a force for harmonization could be even enhanced further. And if I may, I'd like to propose an idea. It would be super helpful if these two indexes were compounded indices were published for every calendar day, and not only on the working days of the respective jurisdictions. That would be very helpful for the management of all multi-currency activities, multi-currency facilities, for IT systems. By the way, I was mentioning that it was a bit of a weak point. So if the two publishers of the manufacturers of the indices could consider that, I'm sure it would be immensely helpful. But I don't want to give you the feeling that I'm always complaining and asking, and I can tell you that also EIB, for its part, pays a lot of attention to coordination, harmonization. Actually, I think it's fair to say that on the bond side, a quasi-perfect, a very strong level of harmonization has been reached by issuers, and we worked on that, and we coordinated a lot with other issuers. And we are also a permanent, I would say, exchange of information and coordination with all the other multilaterals.
Petra, thank you. Edwin, how do the FCA and the Bank of England contribute to the work of the FSB Official Sector Steering Group? Clearly, it's an important role with Andrew Bailey as co-chair alongside John Williams of the Federal Reserve Bank of New York.
Yes, indeed. And I'll comment relatively briefly on this, Paul, because Nate has summarised it so well, which is hopefully a physical example of coordination in practice. But I do appreciate that given the various working groups on LIBOR transition organised at currency level, the Sterling Risk-Free Rate Working Group, the ARC, the Euro Working Group, and the national working groups in Switzerland and Japan, it might sometimes seem to market participants that the transition effort is geographically divided in some way. But I can say that when you're an official in one of the authorities involved, it seems very different. So Cornelia, Nate, Roman and I, we know each other very well because we work together a lot. And as you say, Paul, from the outset, the FSB, or the Financial Stability Board's Official Sector Steering Group, has played a central coordinating role. And while that's been co-chaired by the UK and the US in various combinations over the years, and it is quite a few years now, all the other LIBOR jurisdictions are also very well represented in that group. And indeed a significant number of non-LIBOR jurisdictions too. And I hope that when you look at the big picture, the similarity of the approaches in terms of the destination, but also in terms of much of the roadmap for getting there, is much more striking than some inevitable and sensible differences based on local product types and so on. And I can assure you all that coordination will continue very, very actively. There are lots of practical examples of that on things like conventions. I think it's obviously absolutely tremendous that effectively the whole world has agreed on the same method for calculating fallbacks to LIBOR across derivative contracts. And I see good signs of that common approach also being adopted across cash markets as well, which is really great news. And obviously on things like dealing with the legacy problem as well, we're all very, very alive to the significant benefits from taking a coordinated, dovetailed, and where appropriate, aligned approach. I'll stop there.
Edwin, that's very encouraging. Thank you. Cornelia, is there anything you'd like to add from the ECB's perspective?
Yes, thank you. So I can only echo the very important role of the OSSG, so the Official Sector Steering Group, and also the bilateral contacts that it has facilitated between the various involved parties at the official authorities across the globe. I'd also like to stress that the private working groups, they are also exchanging views, I think, on an unofficial basis. So you have cross-membership, and I also believe that the chairs of the group, they are in contact with each other to see which direction they're going. And finally, I'd like to stress the role of private sector organizations. So for us, really the work that ISDA has been playing in leading the IBOR fallback work for the derivative industry, and the various consultations confirm the appetite for having some consistency across the main international jurisdictions. And for us, this was a key input for the current work on the Euribor fallbacks. And also IGMA, for instance, is bringing its specific expertise on the bond market across other jurisdictions and ensuring thereby that consistency is ensured wherever possible. So this is also very highly valued.
That's very helpful feedback, Cornelia. Thank you. Roman, I know the Swiss National Bank and Swiss National Working Group have been heavily involved at global level as well. Is there anything you'd like to add?
Actually, not much. Everything has been said. I mean, international coordination is happening, but it doesn't mean that you have said it yourself, Paul, in your remarks. It doesn't mean that we will have to end up in a one-size-fits-all approach. Each market is unique, has its unique set of circumstances, and therefore makes perfect sense that each jurisdiction comes up with its own solutions to the problem. But the path is clear, and we're all moving into the same direction.
Thank you, Roman. We're coming to the end of the panel now, but before we do, I'm going to ask each of the panelists in turn for a message in a single sentence that you'd like to leave with international capital markets as a result of this call. I'm going to turn to you each. First of all, Nate.
Well, I guess I would just say that we're really focused on getting this done in the next year and a half. It's super important for us and market participants to prepare. And of course, we want to get it done right. We want it to be as smooth as transition as possible. And we never want to have to do this again. So we want to make sure we're moving on to robust reference rates at the end of the day. I think that might be more than one sentence. Sorry.
That was fine. Thank you. Cornelia.
Yeah, my key message is that Euribor may not be there forever, so my plea to market participants to prepare for that, in particular by implementing fallbacks in contracts and also by monitoring what is happening in other jurisdictions and learn from experience there.
Thank you. Roman.
A lot has been achieved, but there's still a long way to go on many fronts, and the end of 2021 is getting closer fast.
Thank you. Bertrand.
Well, I'm afraid it's along the same lines. We have to do that, and let's work on it, and let's work as efficiently as possible.
Thank you. And finally, Edwin, perhaps I could turn to you.
Thank you, Paul. And this will look, helpfully, I hope, like a nicely coordinated line. So the end of 2021 is approaching fast now. LIBOR transition is no longer a task that you can afford to put off for another year. In the unlikely event that you're listening to this call and you are somebody who's putting it off, I think you're in a pretty small and declining minority. And there are some very particular and urgent tasks for the second half of this year, which you need to have on your agenda, and that includes work on lending without referencing LIBOR and getting that Is2 Protocol signed up so your organization can navigate the period between the end of this year and the end of 2021 safe and sound.
Thank you. Thank you, Edwin. Thank you all.